G'day guys, Joel Seach here, Principal Advisor, Harpel Financial Group. I hope everybody is keeping well and healthy and enjoyed hopefully some nice weather on the weekend wherever you may be, and coming into some new spring weather upcoming, which will be a lovely change from the wet winter. I just wanted to touch base with a really quick video today on an interesting thing I guess I was reading the other day, and also a client mentioned to me, which happens quite a lot in terms of the client just mentioned, when's the current volatility going to end and how the markets react. And I guess essentially the one thing I mentioned is the one thing we can guarantee is there's always going to be something that's going to come up in life, in the markets, in the big environment, in the big world we live in, that is always going to create volatility and uncertainty and change. So the one constant is there's always going to be inconsistencies. There's always going to be things that change and things that alter the markets. And I guess this graph came across my desk, and it was quite an interesting one that I thought it's a good one to see over time here. If you zoom in, or if I zoom in, we can see how we're looking from all the way from 1992 to 2022, and we can have a look at what the different markets have done. So these different charts represent US shares, Australian shares, international shares, property, bonds, cash, and CPI, which is the Consumer Price Index. And you can see all along the time frame here that we've got all the ups and downs, and above here in the little dots just in here, you can see the different things that have popped up over the periods of time that have caused these kind of rippling effects. Some have caused big changes, some have caused minimal changes, and essentially it shows all the different ups and downs that happens. The one consistent we can see there is the gradual incline over time. Even when we have the ups and downs, the peaks and the troughs, that things tend to go in that direction on the slant up over that period, no matter what's happened. And it's got above here all the prime ministers and presidents we've had, all the different wars we've had, all the pandemics or collapses or dot-com booms and bubbles bursting and currency crises. So there's all these different things. So the one constant is there's always things that are going to happen. There's always things that are going to cause ups and downs. But the compounding outcome over time that can really help is essentially maintaining the course, staying the course, and having a good spread. The other interesting thing that I thought I'd bring up was just the importance of the diversification. So again, we've got a 1993 to a 2022 chart here, and the different investment assets that you can have underlying in those areas there. So we've got all the different investment assets over the period, and we've got the best performer and the worst performer. And we can see US shares, international, property, cash, bonds, shares, Australian, and property. And you can see in here all the different areas that have performed differently at different times. Cash being the best performer for last year, which is the one out of the 30-year period. And there's no pattern, there's no consistency. It's all a patchwork. So having that spread and that mix with shares, depending on your age group, property, depending on your age group, and some cash as well, can help sort of diversify and push. And compounding is really the time frame that we talk about. Is compounding is time and time again, having the right mix, having the right asset allocation in there for your situation, and having that good broad mix, general in nature as always with these catch-ups. But when we catch up for your annual planning review, we can go into a bit more detail with it. And the other thing that was an interesting one is the trade-off in terms of whenever we're investing, whenever we have that period of ups and downs, or we have that hit in the market like we're currently experiencing at the moment, is essentially, instead of it being a cost or a detriment, it's more of a fee we pay for having your money in that invested environment, and that risk, that trade-off that we have. So essentially it's the cost for doing business, and it's that mental trade-off and the ups and downs that we're experiencing, and the mental kind of potential worry, or the market uncertainty and those things, is that trade-off for when the light becomes a bit more lighter and things pick up again. Then we experience the upside of what that downsize causes. So there's always a risk-return trade-off when it comes to investing, and we will feel those effects over those periods, and more certainty when we're going through them. And as I've said before, you'll feel it about 2.5 to 3 times more on a downturn than you'll feel on an upturn. And when those upturns happen, then we see the upturns, they tick along, and then what'll happen after that is we'll get another downturn at some period. No one knows when. That's the $1 million question, crystal ball. But essentially it'll happen, and it'll be something that'll go on in the world, and then that will subside and pass, and then things will tick along again. So I thought I'd just give you a quick 5-minute update, just talking a bit about that, and I thought I'd pass that information on, and hopefully you found these graphs and illustrations useful. And any more information, any questions about your own personal situation, just reach out to us at the office every time you need, and we'll look forward to catching up with you soon. Joel Seach, Hubble Financial Group, signing out. Cheers, guys.